let me just ask you how the landscape is looking for private markets. Do you also begin to see activity there starting to dwindle a little bit?
Well, first, thank you for having me on. And to answer your question, yes, we have seen deal activity begin to dry up, whether you look at private equity or at the earlier stages of venture capital. Deal flow is languishing. I think you could point to a variety of factors of why that's the case. In private equity, debt financing is harder to come by. Direct lending funds have filled some of that gap, but the high yield bond and leverage loan markets have been, shall we say, more difficult in the last few months. And on the venture side of things, a lot of those later stage sort of pre-IPO portfolios have been hit pretty hard by this tech sell-off. And so I think deal makers are just a lot more cautious in general.
Well, we actually are just putting up a chart of some of the rates of return here. And it looks as though, as of yet, the IRR for private equity fund return is still leaning towards positive territory. How long do you think it's going to take before the stock market route that we had in the first half of the year to actually filter through to those returns?
So I think it's important to note that we're coming off perhaps the best year in history for private equity returns. PE funds globally returned about 46% on a one-year IRR basis last year. Preliminary numbers show that figure to be about flat, maybe 1 or 2% in the first quarter. And we don't yet have data for Q2, but I think we can take some signs from what we're seeing in public markets. Our data show that private equity returns and the S&P 500 have an R squared of about 0.7 if you look over the last decade or so. And so we can expect that private equity fund returns, or at least mark-to-market returns, will follow that of public markets in the first couple quarters of this year. Now, that being said, I think deal makers will use that as a signal, so to speak, of to pick up deal flow again and to start being more aggressive, especially when it comes to take private transactions. We know from historical data that some of the best performing vintages in private markets are those that began investing right after a downturn. If you look at, say, 2001 to 2003 or 2009 through 2011. And so some deal makers, I believe, are viewing this with a more opportunistic lens.
Dylan, let me pick up that point. I was going to ask you about take privates because I believe 2021 was a record deal for take privates. We know private equity has been sitting on record amounts of dry powder. And when you see a downturn in public markets, surely that is a beautiful opportunity for private equity firms. When could we expect to see them deploy some of this capital? You talk about the potentially investing after a downturn, but when is that? And should they be investing now? Should that be what we expect?
It's hard to know for sure. I'd say in general, look for when volatility dampens a bit in the public markets. I would also keep an eye out on what form those take privates take. So for example, in 2020, when COVID first hit and we saw the sell-off there, we saw a lot more structured financing deals, a lot more preferred equity from firms like Silver Lake and others who saw that dislocation as an opportunity. I think you're likely to see similar deals happen this time, even if it's not full-on take privates. Private equity firms will get involved in capital tables of those publicly traded companies.